Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 224. Today is 10th of May, and the bloodletting just does not stop in the market. Markets fell hard once again, mostly in the small cap and the mid cap space, and the larger caps, however, were still muted. Tried to go up, but still ended in the red, despite overnight futures for the US markets showing up. So it seems to be a global contagion that is currently on. Whether this stops here or it goes much lower remains anybody's guess. We'll take a look at how things have panned out. As you can see today, banking, of course, today was diverging away from the rest of the crowd. So defensives, money going into defensives like FMCG today, up 0.5%. IT, however, was down -1%, and the biggest slash came in metals, energy stocks, commodities, sugar, real estate, and several of these stocks were hammered blue and black, and there was really no place to hide there in that particular segment, especially if they were small and mid caps. Steel and commodity stocks, as I said, crashed out following similar cracks in the Chinese stocks on the same sectors, and I think there has been just unleveraging or deleveraging of many built on positions, given that the global markets continue to reel and we are sitting pretty with not so cheap valuations versus the rest of the emerging markets. So once somebody tries to find a reason to sell, I mean, there are enough reasons to sell from that perspective, but yes, versus a lot of other markets, we may still be doing better than them, if that is any solace. In terms of indices, the Nifty dropped 0.4%, whereas Nifty Next 50 was down 2.2%. So all large caps here also, but predominantly Adani stocks have collapsed today, many dropping as much as 8%. Small caps also down 2%, many stocks in double digit drawdown today. Mid and small caps also near 2%, so pretty sort of bloody crash today in these indices, and some of the weekend investing strategies also bore the brunt, much more than the indices. So MI all cap down 4.4%, a brutal cut there. NNF10 down 3.84%, MI 35 -2.8%, and some of them were faring slightly better than the market, but many of them were brutally cut down after the specific stocks that they're holding collapsed during the last couple of days. Being discretionary has its advantages at times, but being a non-discretionary system that we have, we will go as per our rebalance frequency. A lot of people may take ad hoc decisions on any portfolio, but we will be sticking to the strategy, even if that may mean that we are taking a worse hit than what we could if we acted on a discretionary basis. In the CNX 500 universe, you still had some gainers. GNFC up 7%, Minda up 5%, Brightcom, Aavas Financier, Inox Ledgers between 4 and 5%. So some green spots there, but this is where the actual damage was. Previous special, which has been going from 600 to 2300, has now been cut down to 1200, down 17% again today. This is a major contributor to some losses in some of the strategies. Ratan India Enterprise down 14%, Sri Renuka dropped 10%, Oil India, a large cap company, dropped 9%. Adani Transmission, as I said, Adani stocks are bleeding, down 8%. So if we take a look at the small caps from 17th of January, where they made a sort of a high, we are down nearly 25% in 4 or 5 months, 4 months and some days. and it seems pretty brutal. But we had reached this low even end of February, but this current fall has really taken the floor out of many of the stocks, and that's why it does seem more brutal than the previous one. If we look at the history in the small cap index, we had a major run in small cap index in 2016-17, where the small cap index itself doubled, and then it collapsed 65% from where it had reached. So that fall came over almost 2 years and 3 months. So almost 26-27 months of going from top to bottom, and then you had a ferocious run of 255%, and now we're down 24% from there. So whether we will go further down much deeper and then start the next leg up, or we will just turn around from here and go up is of course I cannot fathom a guess on that. But that's the nature of small caps, to go really fast up when they are going up and go really fast down when they are going down, and hopefully we can make some money going up and maybe not give up all the gains on the way down. So you need to have a complete cycle in your mind to really make on the upside, and then maybe try to reduce on the downside as we come down. Not just Indian stocks, I mean globally stocks have been cracking, and crypto universe has also collapsed alongside. So now we have Bitcoin down 53%, Ethereum, Binance, Terra, Tron, all down between 50 and 80%. So it seems that this crypto world was very much sort of an extension of the technology stocks, in that nature that as long as technology stocks were doing well, crypto was doing well, at least in the short term, in the last couple of years. But now that money is moving out of technology, it seems to have badly hit the crypto world as well. So there is really no asset currently which is really performing well, in the sense, maybe in comparison, maybe gold is doing well, but it is not absolutely going up also right now. So whether it is US market, whether it is Indian market, whether bonds, everything is just because the global yields are going up, inflation is very high, there seems to be no place to hide right now. More insight. So this insight is from Charlie Bilello. The worst performing start to a calendar year, and he has listed last 94 years of data, and we can see that already after 88 days of starting this year, we are at the second worst start to the year in the history of last almost 100 years, and the worst year was the Great Depression in 1932. So it's not looking very pretty on this front. I hope that we can come out of this and do better for the rest of the year, but this is where we are, and we need to remain optimistic. That is the whole point of staying invested for the future, because unless we are optimistic about the future, we will not be able to sustain our position in even a 1% loss any day, because we need to remain optimistic, and there is no reason to be not optimistic, at least in the medium to longer term. But yes, in short term, the way the flows are happening, we may get a deeper cut, if so as to say. But I mean, as I think CLSA has also pointed out, that India remains the best equity market out there. So if there is a chance that the global rout will stop at some point, then India probably will gain the maximum, and we may drop the least amongst them, and we may start off on a positive note. So I think we need to remain optimistic on that front and stay put, because as you have sort of heard and also seen in your journey, that trying to time the market in and out is very, very difficult, and staying in the market remains one of the the features of good returns in any portfolio over a long term. What you can do, however, is to diversify your asset allocation. If you think that equity may have some sort of a lull going forward, you can diversify your asset allocation. I should have done that earlier as well, but this is where we are in terms of, I think the bull market that we had and the run that we had is definitely slowed down. Now whether we will get a huge bounce from here, or we will just sort of wiggle around here till we have a time correction sort of taking place, that is anybody's guess. The last one is on Zomato. So just to highlight the point that how narratives can sort of become misleading. And this company listed at around 100,000 crores of market cap, somewhere around 120 rupees. Then it went to a high of 130 lakh, sort of 1.3 lakh crores, something like that. And from there we are down now to almost 1/3 the valuation at 40,000 crores. And even at 40,000 crores, there is no way to sort of justify that number as well. So it could go to 20,000 crores, it may go up to 100,000 crores. It's very difficult to say. So when you are following a stock based on a narrative, you need to know why you're holding it. If it's a question of fundamental investing, then maybe because this new age companies don't have earnings yet, so you need to have some basis on why you're holding it and where you may be taking an exit, if at all. If it's a blind buy for next 20 years, of course that is a different matter. But this is where somewhat price action based strategies have a huge advantage, that if the price action is not in your favor, like for example, had we been riding Zomato, probably near this breakdown is where you would have gotten out. Yes, you would have lost from 160 to 120, but at least you would not be at 50 rupees today. So from that perspective, price action based strategies give you some sort of a structure to your entries and exits and prevents massive losses. Yes, we will also have losses at times, but a rout of this nature probably will never happen in any of these structured strategies. So thank you so much for watching this. Please do keep sharing these videos with your friends and family, and I'll see you in the video. Bye.